Right now, something unusual is happening behind the scenes of the global financial system, and most people don't even realize it yet. Central banks around the world are making emergency moves that quietly signal fear, not confidence. Interest rates are being adjusted, liquidity is being injected, and balance sheets are being stretched again. And every single time this happens in history, gold and silver react first. If you want to understand where the real warning signs are coming from, stay with me, because this story directly affects your money, your savings, and the future value of hard assets. Before we go deeper, make sure you like this video and subscribe to NeuroSnapx. It helps the channel grow, and it ensures you don't miss critical updates like this, especially when markets are moving faster than the news can explain. Central banks are supposed to be calm, controlled, and predictable. But emergency actions tell a very different story. When inflation refuses to cool down, or when banks quietly struggle with liquidity, central banks step in with tools most people never hear about. They open special lending facilities, inject billions overnight, and sometimes even pause or reverse policies they promised would stay in place. These actions don't happen in strong economies. They happen when the system is under stress. Gold and silver are extremely sensitive to this kind of stress. Gold reacts to loss of trust, while silver reacts to both fear and industrial pressure. When central banks flood the system with money, currencies lose purchasing power over time. Gold doesn't need earnings or growth stories. It only needs uncertainty. That's why central bank buying of gold has surged in recent years, even while official statements claim everything is under control. Silver is even more interesting. Unlike gold, silver is heavily used in technology, energy, and manufacturing. When central banks step in to prevent a slowdown, they are indirectly supporting demand for silver. At the same time, paper markets often suppress silver prices through futures and derivatives. This creates a gap between what the price says and what physical silver actually costs. That gap is one of the clearest signals of market distortion. Emergency actions also affect interest rates in ways most people miss. When rates stay artificially low or are cut suddenly, real yields often turn negative. This is rocket fuel for precious metals. Investors begin to realize that holding cash guarantees loss, while holding gold and silver preserves value. This shift doesn't happen overnight, but once it starts, it accelerates fast. What makes this moment different is that multiple central banks are acting at the same time. The US Federal Reserve, the European Central Bank, and Asian central banks are all dealing with debt pressure, weak growth, and geopolitical risks. When coordination replaces independence, it usually means the problem is bigger than any one country can handle alone. This is why gold often moves quietly before headlines change, and why silver can explode suddenly when confidence breaks. These metals are not reacting to news. They are reacting to policy stress, leverage, and hidden fragility. If this analysis helped you see the bigger picture, let me know in the comments what you think happens next for gold and silver. Share this video with someone who still believes central banks have everything under control. And stay connected with NeuroSnapx, where we break down complex global moves into clear, simple stories that actually make sense.